Hello and welcome to the latest in our series of videos on South African tax. So today I'm going to be talking about this big question: are you a provisional taxpayer? Now, hopefully we know if we're taxpayers or not. We're talking about income tax here, right? But are you a provisional taxpayer? Well, whether you're a provisional taxpayer or not does make a big difference in terms of your compliance obligations. On the one hand, of course, the deadline for submitting income tax returns differs for people who are provisional taxpayers versus non-provisional. We spoke about that in my previous video on the income tax return submission. So have a look at that if you need to. And of course, the other aspect is that if you are a provisional taxpayer, then you have to submit provisional tax returns and make provisional tax payments, and you have to do that every 6 months. So your tax payments are not going to be made only through the employees tax system, PAYE. You are going to be making provisional tax payments as well. And if you don't submit your returns and make your provisional tax payments, and I'm talking here about separate provisional tax returns, not just your annual income tax return. So these are specific provisional tax returns that have to be made every 6 months. And if you don't do that on time, and if you don't make the correct payment, then penalties and interest can apply. So when we talk about provisional tax, and I spoke about making returns and making payments every 6 months, and the issue is that, of course, it depends what your year end is. Now, for individuals, we have a February year end. And so if you're a provisional taxpayer, you would have to submit your first provisional tax return at the end of August into the year, and the second one at year end. So if you look at the February 25 year end, first provisional tax payment and return should have been done at the end of August 24, and the second provisional tax return and payment at the end of February 25. You sometimes hear people talking about a third provisional payment. That's a top-up payment. It's optional, and it can be done if you have a February year end at 7 months after year end. So there's no penalties around the top-up payment, but if you haven't paid up all the tax that you need to pay by the end of September, then interest can apply. All right, but we're going to focus on this whole question of whether you are a provisional taxpayer. Of course, just looking at a different tax year end, if you had a March year end, your first provisional tax would be done in September into the year, the second provisional tax on the last day of the year of assessment. And there again, if you've got a March year, well, here you have a 6-month period for your top up, and that would then be done at the end of September as well. Right, so the question is, are you a provisional taxpayer? Should you have submitted a first provisional tax return for the 25 year? And do you need to do a second provisional tax return? So who exactly is a provisional taxpayer? Well, of course, all of this comes from the Income Tax Act, number 58 of 1962, but don't worry, it has been amended over the last number of years since it was initially enacted. But in the fourth schedule to the Income Tax Act, we have the definition of a provisional taxpayer, and it talks about different types of taxpayers. So any company is a provisional taxpayer automatically, unless it's a non-profit company like a public benefit organization, that's a charity that is registered as a PBO with SARS, recreational clubs, body corporates, share block companies. So those non-profit organizations are not provisional taxpayers, but any other trading company is immediately a provisional taxpayer. And as far as individuals are concerned, or even trusts, well, then it gets a little more complex, all right? So as an individual, let's just focus on individuals for this video. If you carry on a business, your own business as a sole trader, then you're a provisional taxpayer. Or it can also be other people who don't necessarily carry on their own business, even people who are earning remuneration, earning a salary if they earn other income, all right? If they earn income other than their remuneration from a registered employer. So we've got to read all of that together, not just remuneration, but remuneration from a registered employer. That means the assumption is that you are paying the correct amount of PAYE on that remuneration, and that's one way that SARS recovers tax. Now, the purpose of provisional tax is to say that if you're earning other income, well, then there must be another mechanism to pay tax on that other income, and that comes through the provisional tax system. So if you're earning income other than remuneration from a registered employer, that would be subject to PAYE. But there are some exemptions. So again, it always gets complex with tax. There's the rules, and then there's exceptions and so on. So the exceptions, and this is for individuals, right? I've already said all trading companies are provisional taxpayers. Individuals, remember that if you earn income other than remuneration. Now, even there, if you've got an individual with income other than remuneration, as long as they're not carrying on business, they may, in fact, not be a provisional taxpayer. So what we're saying here is that as soon as you earn income from carrying on a business, you go straight into the category of provisional taxpayer. If you're not carrying on business, your own business as a sole trader, but you've got other income, like, for example, interest, dividends, rental from property that you might rent out, okay, that sort of thing. So if you have other income, then you would be a provisional taxpayer. But if one of these conditions applies and you don't carry on business, then you're not a provisional taxpayer. So either your total taxable income for the year is below the tax threshold. So the tax threshold is the point at which, the amount of taxable income at which you start paying tax. And taxable income is a calculated number. It starts with gross income, like your salary, your rental income, etc. Take out anything that might be exempt and subtract any deductions that you may be entitled to, and that leaves you essentially with taxable income. And on that number, you would normally calculate how much tax you have to pay. So for individuals under the age of 65, you can get taxable income up to 95750 per year before you have to pay tax. So that's your tax threshold, all right? If you're between 65 and 75, you get an additional rebate, and so that takes your taxable income higher, and it goes even higher if you are over 75. So if you're under 65, you've got other income other than your remuneration that's subject to PAYE, but your total taxable income does not exceed 95750, then you would not be a provisional taxpayer, because actually you're not a taxpayer at all, because you don't have sufficient taxable income to pay tax. On the other hand, and so we're saying, right, you have got income other than remuneration, but you're not carrying on a business, but your taxable income is above the threshold. However, you've got income other than remuneration, and when you look at that other income that comes from interest, dividends, foreign dividends, rental from fixed property, and any remuneration from an unregistered employer, right? So that's remuneration on which you're not paying PAYE. We call that's a sort of other income, as long as the combination of all of that does not exceed 30,000 Rand. So if you earn a little bit of interest, a little bit of foreign dividends, a little bit of rental, as long as the taxable income from all of that together does not exceed 30,000. So you might earn R1 million remuneration, and you might earn a certain amount of interest, as long as the taxable income from the interest does not exceed 30,000, you will not be a provisional taxpayer. Now we'll go through some examples to illustrate this. Let's have a look at the first one. Let's take somebody called Sue, fictional person, age 32, and let's assume she has in this current tax year up to the end of February 2025. She's got salary income 650,000, and there she earns interest income and dividends. All right, so that's also other forms of income. So she's got income other than remuneration. But when we look at her taxable income from interest, so because she's under the age of 65, 23,800 is exempt. That's automatic for everybody under the age of 65. You get that interest exemption on your South African interest. And so her taxable income from interest is 24,200. Dividends, well, all SA dividends are exempt essentially. And so there's no taxable income from dividends. So although she earned 50,000 Rand of dividend, it's all exempt, so there's no taxable income. So the combination of her interest and dividends, how much taxable income comes from that? 24,200, all right? Now, if we look at her deductions, she's contributed to a pension fund. She gets a deduction for those contributions. So her taxable income is 609,200. Now, what are we looking at here? We're saying she's got income other than remuneration. Her taxable income is above the tax threshold, all right? Because the tax threshold, we said, for somebody under the age of 65 is 95,750. So she's well above the tax threshold. But if you look at that combination of the taxable income from other income it's less than 30,000, right? It's only 24,200 in total. And so she would fall into this exemption over here, where we're saying, yes, her taxable income does exceed the threshold, but her other income does not exceed 30,000 and she's not carrying on a business. And so that means she would not be a provisional taxpayer. Okay, so she's not a provisional taxpayer, even though she's earning other income. Let's have a look at this example. Joe, age 67, he's got a pension annuity. He's got South African interest and dividends as well. More interest, more dividends, because he's built up a nice little portfolio there to assist with funding his retirement. And so let's look at his interest income. He's over the age of 65, so he gets an exemption of 34,500. So his taxable interest is 53,500. Again, South African dividends, local dividends, they're all exempt, so no taxable income there. Right, so his total taxable income is 143,500. Okay, now, remember that we have to say, does he earn income other than remuneration? Yes, he does. Is his taxable income above the threshold? Well, on this slide here, we said 65 to 75, the threshold is 148,217 taxable income. So his taxable income is below the tax threshold. So that means although he has other income, and indeed his other income is more than 30,000, but he is below the tax threshold. And so that means he would not be a provisional taxpayer, because actually if you worked out the tax on that taxable income and took into account his additional rebate for being over the age of 65, there would be no tax payable. So he would not be a provisional taxpayer. But let's look at this third one. So here we have Thabo, age 66. He has income salary of 750,000 and he earns a nice amount of South African interest, 78,000 for the year. He's over the age of 65, so he gets that exemption of 34,500. So his taxable income from interest is 43,500. So again, he's got income other than remuneration. He's not carrying on a business. He's just an investor earning this interest income. He's got income other than remuneration, and that income, that taxable amount of that income is more than 30,000 Rand. And his taxable income is definitely above the tax threshold. Right, so that means that he is then going to be a provisional taxpayer. He's got income other than remuneration, that is more than 30,000 Rand. He's above the tax threshold, and so he is a provisional taxpayer. So I've illustrated for you here the questions that we go through to establish whether an individual is a provisional taxpayer. And just to do a quick recap, so we said any company other than a non-profit essentially is a provisional taxpayer. Any other person, individual or trust, if they either carry on business or they earn income other than remuneration from a registered employer, they would be a provisional taxpayer unless they fall into this exemption where they're not carrying on business and either their total taxable income is less than the threshold, or if we look at their other income and we say how much is derived from interest, dividends, foreign dividends, rental, and let's call it untaxed remuneration, that must be less than 30,000 Rand. All right, so if you don't fit into those exemptions and you do earn other income, similar to what we saw in the example with Thabo, that person would be a provisional taxpayer. What happens if you are a provisional taxpayer? Well, you don't actually register. There used to be a requirement to register as a provisional taxpayer, but that fell away actually back in 2016. So there's no longer a requirement to register as a provisional taxpayer. The onus is actually on the taxpayer to establish for themselves whether they're a provisional taxpayer or not. And if the person is a provisional taxpayer, then they are obliged to do what's required of a provisional taxpayer. And that means they must submit the necessary provisional tax returns, calculate their provisional tax, and make the payment that is due by the due date. And if you don't comply with all of those requirements, then you end up with penalties and interest. In another video, the next video, we'll talk about how to actually calculate your provisional tax payments if you are a provisional taxpayer. But this hopefully just gives you an idea of how to work out whether you are a provisional taxpayer or not. And remember that if you are a provisional taxpayer, you need to comply with the necessary requirements. So look out for the next video where we'll do the calculation of the provisional tax payments. If you enjoyed this video, if you found it valuable, please like and subscribe, and we look forward to having you joining us on our future videos. Thank you. Goodbye.